Hi, ladies and gentlemen, how are you today? Are you guys okay? I'm Jumbo. I can't hear anybody here. At least Juliana has made a comment there, and she seems to be good in Swahili, which is very good, very good, very good. So we're going to look at something very, very small called IS 19. IS 19, I'm so sure most of you are saying that cannot come, but we shall look at IS 19 today. IS 19 today. All right, and then I shall be able to begin. We shall overcome. 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 Now, ladies and gentlemen, this is what I would want us to do today. Just something very small here. This is what I want us to do today. Let me just project this. So we have this here. Yes. So let me know once you are able to see my Excel sheet. Let me know once you are able to see my Excel sheet. All right. So they have told us, ladies and gentlemen, here is something very, very interesting here regarding IS 19 issues to do with long-term benefits. So we are told here, Joydan, a public limited company, is a leading support services company which focuses on the building industry. The company would like advice on how to treat certain items under IS 19 employee benefits. The company operates the Joydan Pension Plan B, which commenced on 1st November X6, and Joydan Pension Plan A, which was closed to new entrants from 31st October 06, but which was open to future service accrual for the employees already in the scheme. The assets of the scheme are held separately from those of the company in funds under the control of trustees. The following information relates to the two schemes. We have here Pension A. The terms of the plan are as follows. You can see here employees contribute 6% of their salaries to the plan. So employees are contributing, and then the company currently the same amount they plan for the benefit of the employees. So the company is doing 6% and the employees are doing 6%. Very clear there. 3, on retirement, employees are guaranteed a pension which is based upon the number of years of service with the company and their final salary. So according to your understanding, my good students here, then automatically we are guaranteeing these employees of ours a particular amount of pension. Which kind of scheme is this? Is it a DB or a DC? Is it a defined benefit or a defined contribution? Yes, we're making contributions, but the fact that we have guaranteed these guys they'll be earning into the tens of millions, we are going to give them some amount of benefit when they retire. It becomes a defined what year? A defined benefits scheme. It becomes a defined benefits scheme because you have defined the end game, the end goal. We know that these guys will be getting this benefit at the end of the day. That's very good. That's very good. That's very good. Now, ladies and gentlemen, then they come here. I would want you to take a screenshot of this. A screenshot of this information. We can see the present value of obligation. We can see the present value of obligation here. Present value of obligation at the beginning of 06, 200. Present value of obligation at the end of the year, our financial year. And then we have fair value of plan assets at the beginning, fair value of plan assets at the end. The current service cost has been given. Pension benefits paid has been given. Total contributions to the scheme has also been given. The measurement gains and losses are recognized in accordance with the IAS 19. Assume that contributions are paid into the plan and the pension benefits are withdrawn from the plan on that date. So they simply want us to give them an extract, profit and loss account for this plan A. Extract, profit and loss account of this plan A, of this pension scheme, plan A, which is a DB, which is a DB. I want you guys to take a screenshot of this. Please take a screenshot of this. Take a screenshot of this. So there are two ways of you handling this very, very easily. Two ways of you handling this very easily. Two ways of handling this very easily. You can decide in this case here to do a plan assets account and a plan liabilities account. You can decide to do that. So we have here a column for plan assets. Plan assets. And then we have another column here for plan what year? Plan obligations. Plan obligations. Plan obligations like that. So then we shall start here. If we are going for this approach, we shall start with the opening balances. Opening balances. So is there somebody who is able to see the opening balance? That is X6 figures. The X6 figures beginning, or if you had 1st of January, we should have brought here 1st of January. So is there somebody who is able to give us, ladies and gentlemen, this opening balances really? Do we have good ninjas who are able to do that? Do we have good ninjas who are able to do that? Do we have good ninjas who are able to do that? Good ninjas who are able to do that? Who are able to give us the plan? Let me just share the screen again. So we are told here, you can see present value of obligation, 06. So present value of obligation, this is what was brought forward, is 200. All right. So brought forward, opening balance, plan obligation brought forward is 200 here. Obligation brought forward is 200. It's 200 there. And then, ladies and gentlemen, just give me 1 minute. Adjust my camera better. 190 and 200, great. All right. So then we have in this case here the plan assets brought forward. So we have here, first of all, the plan obligation brought forward is 200. This obligation at the end is obligation carried down. I want the brought forward. Then I can see the fair value of plan assets here brought forward, 190. You guys are great. You're geniuses here. So we have here 190 here. Of course, we expect this to earn interest. So come and tell me in this case here, interest on assets. So we have here interest on assets. And then of course, obligations also, this is a loan to us. So we have here interest on what here? Obligations. So please look for the interest which in this case here was available to us at the beginning, that is 06. 06, this examiner has given us figures here. This examiner has given us figures here. At times he'll call them discount rate. Can use whichever. The interest rate on high quality corporate bonds for the two plans. 1st November, applicable to opening balances. This will be the subsequent year. Don't take this 2017. Opening balances, we shall always use the 2016 figure. The first figure given here. If it was, for example, like a year running from January to December, then I would have picked the interest rate, which prevailed on the 1st of January 20x6, whatever, like that. All right. So then we are working with 5% in either case, 5%. So is that somebody who can give me the interest on assets here, 5% of 190. So an asset will be 5% of this 190. On obligation will be 5% of 200. What figures are they giving me? So according to Hilda, assets will be 9.5. How about interest on obligation, 5% of 200? That will be 10. Thank you so much. This will be 10. This will be 10. This will be 10. Ladies and gentlemen, from there, we ask ourselves, what else do we have here? What else do we have here? I told you to screenshot this. It's very interesting. You need to screenshot this information. Is very, very important. Then we can see, ladies and gentlemen, the current service cost. Remember, as these employees are working for us, we expect the liability to go up because the more they serve us, the more the liability. So the current service cost, I can see a figure of 20. This will only increase the liability section. So we have here current service cost. Current service cost. So current service cost, we've said in this case, it will be what there? It will be 20. It will be 20. From there, I'll ask myself whether any contributions these people made in the year. Yes, you can see here, total contributions paid to the scheme. Total contributions paid to the scheme was 17. So when you pay contributions to the scheme, then the assets of the scheme increase. The assets of the scheme increase. So we have here contributions to the scheme. Contributions to the scheme. How much? I forgot to pick the figure. 17. Thank you very much. So this will only be applicable here. That will only be applicable there. And then, ladies and gentlemen, if you're following this approach of doing this separately, if you're following the approach of doing this separately, then you must bring in the elements of what here? Benefits paid. Benefits paid. Of course, when we pay benefits, our assets, cash reduces. Our asset will reduce, and of course, the obligation will reduce as well. So is there somebody who is able to see the benefits that we paid here? How much benefits do we pay? Benefits we paid. Benefits we paid. Is there somebody who can see the benefits that we paid here? 19. So the benefits in this case that we paid were 19, and then these will be applicable in the two cases. And that is why when we are talking of the other approach, we will simply leave the benefits paid always out because it normally knocks on the two accounts equally. So then come and give me the expected closing balances. Give me the expected closing B, expected closing balances. Is there somebody who has figures here for expected closing balances? So I can see we are 103. I expected today to have like 300 students here. Where are other students? I can see we are 103 in Zoom. So please try to talk to your colleagues. Tell your colleagues that we are in class. You're in class, serious business happening here. So please give me this figure. So according to Hilda, it is 197.5. It is 197.5. And then plan obligations, 221, right? Plan obligations, we have here, who is telling me the truth? 211 and 221. Who is telling me the truth? 211, right? 211. So 211. Now from here, ladies and gentlemen, you need to come and give me the actual closing balances. The actual closing B. The actual closing balances. So the actual closing balances for the obligations and for the assets. You can see here the 107, end of the year. So like the present value of obligation at the end of the year was 240. So we have 240 for the obligation. So here we have 240 for the obligation, 240 for the obligation. How about the closing balance for the asset? Is there somebody who is able to tell us what is the closing balance for the asset? So closing balance for the asset, this is what we have here for the asset, closing balance for the asset. It is 200 what year? All right. Already I can see guys giving me figures here. I can see guys giving me figure here for the asset. Is there somebody who is able to see the figure for the asset? 225 years, 225. And then come and they give us, the difference of course is what we shall be bringing and booking here as a remeasurement. What the old standard, we used to call actuarial gain, actually we can still call the same, but the proper term should be remeasurement. Remeasurement component, remeasurement. So of course, here we shall call it the actuarial gain or loss, like that. Actual gain or loss, like that. So like our assets, we were supposed to be having 197.5, but actually they were more. So I can see in this case here again. So for the asset, it will be again. What is 225 minus 197.5, ladies and gentlemen? So they're giving me 27.5. So the gain here is 27.5. How about the liabilities, the obligation? It was actually supposed to be 211, but I can see it is more. When liabilities increase, we are losing. When liabilities increase, we are losing. When liabilities increase, we are losing. So it is a loss of 29 in brackets like that. It's a loss of 29 in brackets like that. Let me know, ladies and gentlemen, once you guys are able to write this in full. Once you guys are able to write this in full, are you able to put your thumbs up there? The actual gain, the loss is in the brackets. Once you guys are able to write this perfectly well, thank you. I can see already thumbs up. So then come and give me the net. Then what is the net? What is the net actual gain or loss? What is the net actual gain or loss or remeasurement component? So you take this 27.5 minus 29. I can see negative is more. So this one here gives us what here? This one gives us 1.5. This gives us 1.5. This gives us 1.5 loss like that. So it's an actuarial loss like that. I've been forced to do this question this way because I've seen some of your questions where the examiner simply comes and tells you, do a plan assets account alone. Do a plan obligations alone. So if he tells you to do any of the accounts, then I think now you guys are what here? You are comfortable. You are comfortable. So unfortunately, we forgot to record, but fortunately, this same video is being cast live on YouTube. So you shall be able to get it from YouTube and then we give it to you. We give it to you. All right. So ladies and gentlemen, can I commence now straight away and do this question the way we normally do it in class? Can I commence and do this question normally the way we do it in class? Using the net obligations approach. Using the net obligations approach. The better approach. The better approach. The better approach. Using the net obligations approach. Using the net. So method 2. I really love the second method. Method 2. So method 2 is the net obligations approach. What we can call in this case here OA, net obligations approach. Obligations minus what here? Minus assets. So obligations minus assets. Obligations minus what here? Assets here. So and really this is very easy because what I'll do, I'll come here very fast and talk of opening obligation. Opening net obligation, call it net obligation. Net obligation. So basically, you will take in this case here the opening obligation minus opening assets. You must always begin with obligation because pension obligations are always more. They're always higher. They're always higher. So is there somebody who is able to see the opening? Opening. Let's start with obligations first. So abracadabra, opening obligation, I can see 406, it was 200. So I'm using the OR approach. So you take 200 minus the opening assets. So the opening assets, what do we have here? Opening assets, is there somebody who is able to see the opening assets? I think I'm alone. I think out of the 108 students who are in Zoom here, I'm alone. So in this case here, the opening assets are worth how much? 190, yes. So we have here 190. So this gives me 10. So please go ahead and pay interest on this. So in this case here, add interest. Add interest. So interest, we saw the percentage is 5%. So 5% of 10 gives me what, somebody there? 5% of 10. 5% of 10. I'm waiting to hear from you guys. 0.5, isn't it? 0.5. In this case here, these wheel roads, these guys are working. These guys are working. We expect our obligations to increase. So come here and give me, the current service cost. Current service cost. Are you able to see the current service cost? Yeah, current service cost. They're giving me a figure of what here? Current service cost, they're giving me 20. They're giving me 20. Current service cost, they're giving me a figure of what here? A figure of 20. They're giving me a figure of 20. They're giving me a figure of 20 like that. That is current service cost, 20. What else do we have, ladies and gentlemen? We have here these pension benefits paid. What do you think of pension benefits paid? What do we do with these pension benefits paid? If you're using net obligations approach, remember, benefits paid will be under OR. Under OR, it will be under obligation and it will be under assets. So it will be what here? 0. It shall always be omitted. Benefits paid, you're using this approach. It's contra, so we leave it out. And then now we have, ladies and gentlemen, here, the contributions to the scheme. Hot AIS, contributes to the scheme. What do we have here? Somebody contribute to the scheme. Are you able to see the amount? Contributions to the scheme. Are you able to see the amount, ladies and gentlemen, here? Wait, they're not talking to me. So this contributions to the scheme, they're telling me it is what here, they're not telling me anything. They're not telling me anything. Contributions to the scheme, they're not telling me anything. It is 17. So in this case here, contributions paid. 17. So this 17, should it be positive or negative? Positive or negative? Negative, simply because this is what here, this is an obligation and this is an asset. So we need to come and do what here? Deduct. We deduct like that. And ladies and gentlemen, that is it. So come here and give us the expected closing net obligation. Net obligation. Is there somebody who is able to give me this expected closing net obligation? According to Yvonne, 13.5. And then we'll come here and give me the actual closing net obligation. Don't forget OR. Don't forget OR. We have obligation minus what here? Assets. Closing, the October 07 figures. The October 07 figures. So we have here obligation closing is 240 minus assets closing 225. 240 and 225. What are we able to see there, ladies and gentlemen? 15, isn't it? So in this case here, 240 minus 225. So they're giving me a figure of 15 like that. So come and give me the measurement component. Give me the measurement component, what we are calling the actuarial gain or loss into bracket like that. Are you able to see that figure of 1.5 and it happens to be a loss? Are you able to see that figure of 1.5 and it happens to be a loss? All right. So that is it. 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 And then now we should be able to go ahead and do what here? Give them an extract income statement. So go ahead and give them an extract income statement, comprehensive income statement, extract comprehensive income statement, extract comprehensive income statement. So we shall start with the P&L. So under P&L, what do we do here? We shall take only two things here under P&L. We shall take, in this case here, the service cost. So do we know the service cost? Service cost is how much? Service cost, we have the service cost, which is 20, right? Service cost is 20. And then, of course, we shall take what we call the net interest. Net interest. Net interest over how much? The net interest over how much? They're not able to see my board. We shall overcome. Net interest over how much? You know, you have the net interest here. Net interest here. Net interest, which is 0.59. And then, of course, we have OCI, where, of course, we know this actually, this remeasurement component will go to OCI. So in this case here, we have the remeasurement component, which happens to be a 1.5. You can either put it in brackets like that, remeasurement component of 1.5, or you simply say remeasurement component loss, and then you write 1.5 positive like that. And you'll be able to get all the marks. You'll be able to get all the marks. You'll be able to get all the marks. So does this question serve like a very good reminder of this standard? Does it serve as a very good reminder of this standard? All right. Now, I would want to draw your attention to something. I would want us to see something very, very important here. Now, you know, there are always tweaks in these standards. Like initially, 2011, before 2011, we used to talk about the corridor approach. Again, the other day, we used to bring in this case here like these past service costs and add them to the opening balances while getting interest. Those things are no longer there in IAS 19. In IAS 19, those things have been removed. Those things have been removed. And this is what we normally do. Let me just give you something here. Let me give you something here. You know, there's a ninja who told me that Mwalimu, this will not come. Who tells you? Who tells you? If there is anybody who's supposed to be predicting exams, given our years of experience, it is us. We are experiencing AFR for the very first time. Only 3 months old, and now we want to start predicting exams. We want to start predicting exams. We shall overcome. 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 Now, ladies and gentlemen, look at this question here. Very short question. So we are told here defined benefit pension scheme, e-commerce company is worried. I will not be able to send these books to you now any longer because I don't want to keep on pumping so much stuff to you guys. I expect you guys to take like a screenshot here. A screenshot here. So e-commerce company is worried that the poor remuneration package offered to employees is putting the company at risk of reputational damage. Consequently, e-commerce company changed its pension scheme on 30th September 05 to include all of its staff. The benefits accrue from the date of their employment, but only vest after 2 years additional service from 30th September 05. The net pension obligation at 30th September 05 of $78 million has been updated to include this change. During the year, benefits of $6 million were paid under the scheme under e-commerce, and the e-commerce company contributed $10 million to the scheme. These payments had been recorded in the financial statements, but no other entries for the year have been made. The following information relates to the pension scheme. So the net pension obligation, you see now here you can't use that thing of putting plan assets aside, plan obligations aside. No. Here they have given us the concept of net obligation. So the net pension obligation, we have your net pension obligation at the beginning, current service cost, past service cost relating to the scheme, discount rate is also given there. So, ladies and gentlemen, I would want you guys to do me a favor. Please do me a favor. They want you to do something very simple. What do they want you to do? They want you to come here, advise e-commerce company on the principles of accounting for the pension scheme, including calculations for the year ended 30 September 05 for 7 marks. If SCCA gives 7 marks, customer will give you guys 10 marks. So we want to keep silent a little bit just for 5 minutes. And then we get to see whether there is any ninja serious accountant here who is able to do proper accounting of this particular pension scheme under dictates of IAS 19. Under dictates of IAS 19, do we have a serious IFRS ninja here? So serious ninjas are trying to, work out something, even if it will be wrong. So long as they try working out something. Let's see how they work this out. So remember here we have that thing that is in yellow there, past service cost. Even if you are to add it when you are getting interest, we'll still close our eyes. But the thing is, no, don't be sure that these past service costs are accrued from previous. No. We are simply bringing in an actuary who will be able to come and tell us, you know what, this pension thing, given the benefit you've guaranteed, you may not be able to pay. So add something. So you're adding this thing this year. Of course, it's arising from past surveys, our old employees, but at the end of the day, we are doing the addition this year. So that one should never form part of our opening balance. We shall not be including this in the computations of the interest, in the computation of the interest. Let's see, abracadabra, this serious ninja. Who is this serious ninja? Who is this serious ninja? Who is this serious ninja? I can see Nancy is raising a very valid point there, but she's attracting some great talks there. There are people who are seeing her as an enemy of progress. That Mwalimu, don't give us predictions. Mwalimu, we are comfortable. You've taught everything. But I can see some ninjas there are not really impressed with her comment there. Some ninjas there are not really impressed by her comment there. I can imagine what will happen when we shall be having our get-together very soon, when I'll be calling all students, in this case, to Nairobi. And then, of course, Nancy will be in the Middle East, and people will be telling Nancy, you know what, you never wanted us to be given anything. You are an enemy of no. She is the one who is right. She's the one who is right. All right. So this, I'm waiting to see whether there is anybody who will be able to give me the actual gain or loss in this case here. Actual gain or loss in this case here, what do we have? All right. Then what I'll do, I will come here and post the solution to see whether there is any ninja who has been able to do this very, very well. Just post this here. Oh, Lorraine says 4.755 gain. Immaculate says 10.01. She has not told us whether it's a gain or a loss, meaning that we are almost there, all of us, in terms of calculating this gain or loss. So I'll give you 2 more minutes. I'll give you 2 more minutes, 2 more minutes. We see who is going to get this right. And then it's a long time ago since I gave my students a present. I have a feeling that I should be able to give a student who gets this correctly. We should be able to give them a present today. So then I would suggest that, of course, you write your answer and your mobile number by the side. To make things easy, write your answer and your mobile number there by the side. And your mobile number by the side for us to see who is correct and who is wrong. Or rather, I think the best thing for us to do is just to, let's see there, 5.25, Godfrey Mwangi, abracadabra, abracadabra. 1 more minute, 1 more minute, 1 more minute. Comp says gain of 1.2, 1.2, 1.2 gain, 1.2 gain, 1.2 gain, 1.2 gain, 1.2 gain. All right, so that 1 minute is over. Any subsequent answers coming, now they are disqualified. Or do I add them like 3 seconds? No. I can now see they are coming in quite fast. Now they're coming in quite fast. Now the person who has it right is this ninja. Let me just come here. If you're able to see the answer is here. The answer is here. This is the answer. The measurement, the balancing figure is 1.2. 1.2, 1.2, 1.2, 1.2, 1.2, 1.2. Let me do it for you to be able to see whether it is a gain or a loss in a better way. Let me do it. Let me do it. Let me do it for you guys to be able to see whether it is a gain or a loss in a better way. In a better way. In a better way. What do we have, ladies and gentlemen? So come back. we shall overcome. Don't worry. We shall overcome. We shall overcome. So what I want you guys to do here is to come and just do this question slowly. Slowly. 3 marks really. 10 marks free. You're being given 10 marks in this case here by somebody who is wishing you what here? Who is wishing you success? Who is wishing you success? By somebody wishing you success. By somebody wishing you success. By somebody who is wishing you success. So we have what we have, ladies and gentlemen, here. I'll simply copy this. So we have here the opening net obligation. Please give me the figures now. We have here the opening net obligation. Opening net obligation. Are you able to see that figure? Opening net obligation. 59, right? 59. So in this case here, come and give me the interest. So please, the interest, because they are past service cost, don't tell me that we'll take 59 plus the past service cost times the percent. No. Interest, what is the rate of interest given? They may call it whatever they call it, the rate of interest, discount, the rate of interest. So in this case here, the interest rate at the beginning is 5.5, not 5.9, at the beginning, 5.5%. All right, so then we have here 59 times 5.5%, which gave you guys what figure? Which gave you guys what figure? We shall overcome the road, don't worry. Which gave you guys what figure? 3 point something. 3.245. 3.245. And then we have, ladies and gentlemen, what we call service cost. So service cost shall always be current and past. You can decide to split them. You can decide to split them. But you should always, you can combine them, you know. So in this case here, we have here the current service cost. Current service cost. And then we have the past service cost. So current service cost of how much? Current service cost of how much? $18. How about in this case here, service, or rather the past service cost? Past service cost, 9. Past service cost, 9. So when getting interest, you shall not include this past service cost here. Don't tell me it's 9 plus 9. No. That used to be an old style. All right. Ladies and gentlemen, what else will affect this thing? We have the contributions here. Contributions done by the company, not by the employees. So contribution, we less 10. Contribution done by the company. The portion of employees you subtract. And that is it. So then we have here the expected net obligation. Expected opening net closing net obligation. Is there somebody who is able to give me this figure? Is there anybody who is able to give us this figure? 79.2. So we have here 79.2, 79.245, 79.245, and then we have here our actual closing obligation. Actual closing obligation ni ngapi? 78. So in this case, the obligation has reduced, isn't it? The obligation has reduced. So is that a gain or a loss? Is that a gain or a loss? It's a gain, yes. So in this case here, we have our remeasurement component. We have our remeasurement component, which is an actuarial gain of how much? Of 1.245. 1.245. So anybody who was able to get this gain of 1.245 or 1.2, that ninja is correct and they should be motivated, should be given money. That ninja should get money. If you got 1.2 gain or 1.245 gain, you should get the present, yes. You should get the present. You should get the present here. You should get the present here. You should get the present here. So who was the very first ninja to get it right? Is it really this ninja called Nancy or Anne? Who was the first ninja to get it right? Who was the first ninja to get it right? There is a student who is asking there, why are we not subtracting the benefits that were paid? You see, benefits paid will be affecting assets and will be affecting liabilities, obligations. So normally it's like what somebody told us, contract appears in both accounts. So benefits, not unless you're using the other approach, which I started by doing here. So benefits paid shall always be so I should get my phone and do something, right? So it is Anne. So Anne, please give me your number. It's Anne. Yes, the P and L, the P and L will take both. You will take both. Let me just show you how they do it here. If you look at the solution, in the P and L, you always take both. Profit, where they are doing the profit adjustments, you can see they are taking current and past service cost and they added together 27. They added together 27. All right. So this ninja called Anne, she's not really great question there. This ninja called Anne is now wasting our time. All right. This ninja called Anne She's not writing her number here. Perhaps she's not even here in the meeting. This ninja called Anne. So the gentlemen, the next thing that I would want you really to be good at is this. So that ninja, when that ninja comes, don't forget to tell her I have her present. So IAS 19, accounting for employee benefits, differences between defined benefit and defined contribution pension plans. You must have seen your examiner giving you up to 6 marks to differentiate between the two. So for 6 marks, you can't just go and tell us that, you know what, for defined benefit, the benefit is known in advance and it shall not change. No, you only get 1 or 2 marks. So allow Mwalimu to read here. Defined benefit plan, DB. A defined benefit plan promises a specified pension benefit. It promises a specified pension benefit, usually based on factors such as years of service and salary history. You serve us for this number of years and you'll be getting this salary by this time. Then we shall be able to give you 10 million. So we're going to specify some pension benefit receivable obligation. The employers bear the financial risks associated with the plan, including investment performance and longevity risk. The risk that retirees live longer than expected. Remember, if retirees live longer than expected, then you're going to pay them more. So in this case, the person will be troubled. I mean, you're working with this employee throughout. That's why we call it post-employment. Even after employment, you still have this guy. So if he stays on this earth for a very long time, then you're going to suffer really as a company, given the kind of what-year pension plan you are guaranteed them. So of course, then your prayer as an employer, if you go for the defined benefit, is that these people should die very bad prayer. Accounting treatment recognizes the net defined benefit liability or asset on the balance sheet, which represents the present value of the obligation less the fair value of the plan assets. So at the end of the year, ladies and gentlemen, we are going to have the net defined benefit liability. In small probability asset, normally it's net obligation. And how do we get this net obligation? It is OR. It is the obligation at the end of the year minus the plan assets at the end of the year. And then, of course, obligation, because obligation will be paid much later, obligation shall always be done what? Discounted. That's why we are calling them present value. It requires us to have an actuary. Requires actuarial valuation to determine the present value of the defined benefit obligation, the DBO, and the fair value of plan assets. Recognizes net interest, service cost, and remeasurement of the net benefit liability in the P&L. So that's defined benefit plan. Defined benefit plan, ladies and gentlemen. Then we got the defined contribution, what we call the DC. In a defined contribution plan, my liability is only the contributions that I'm making to the fund. What happens thereafter when these guys retire is none of my business. Is none of my business. Definition: in a defined contribution plan, the employer/employee contributes to a retirement account, but the eventual benefit is not predetermined. How much you shall get is not known in advance. The obligation: employers typically do not bear the investment or longevity risk. Instead, the risk falls on the employees, who bear the investment risk and longevity risk. Accounting treatment recognizes contributions to the plan as expenses when they are due. So we shall not be having, in this case, ladies and gentlemen, these contributions. All right. What we shall do at the end of the day in terms of our accounting in terms of accounting, ladies and gentlemen, we shall not be having like current, non-current assets, non-current, no. This is short term. Ours is simply to pay the monthly contributions, the yearly contributions. If it is just outstanding, then it will be outstanding like say a month or two at the beginning of the year, next year that is. It can never be, in this case, like a long-term obligation. So basically here, we are being told accounting treatment, we shall recognize contributions to the plan as expenses when they are due. So we shall debit, in this case, the P&L with these contribution plans here. No obligation for future benefits on the balance sheet. Only the contributions made to the plan are recognized. No actuarial valuations required as there are no defined benefit obligation. There are no defined benefit obligation. There are no defined benefit obligation. Now, a student has asked up there, Mwalimu, between that method there where we have plan assets and plan obligation, and this other method of net obligation, which method shall we use in an exam? Which method? Unajua nategemea. Wacha nikwambie kwa nategemea. Unaweza ukaenda usikie unaambiwa kwamba like the obligation interest is 6% and the assets interest is 10%. In that case, do you think you can net these things off? No, you have to do separately. If the rates of interest are different, you have to do separately. I'm wondering, for example, like now this question that we have done, the one that Anna has won, and she has not given me her number. Where you get the examiner has given you the net obligation directly. Can you go for, you can't even see the assets. So you simply need to be good in both methods. You simply need to be good in both methods. But of course, should you get a choice, the net obligation is better, is kidole juu namna hiyo. All right. So is there anybody who is able to see Anne's number, or am I the one who is pretending not to see it? Thank you. I've now seen it. Thank you very much. Thank you very much. Thank you very much. It has been posted by her. Thank you very much. All right, ladies and gentlemen, here we are. Here we are. And I think the gifts that we should give now towards the end of the semester, they should be bigger. The gifts we give at the end of the semester, they should be much bigger, really. We should not be giving very, very small gifts. All right, ladies and gentlemen, here we are. Okay, so then I'm now left with one area alone that I can see everybody is talking about, this concept on what here? On diluted EPS. So because I have another class starting immediately at 2 p.m., I would prefer we take that up in my tomorrow's, early morning tomorrow AFR, we have a class at 2 p.m. Does that sound like a good plan? 2 p.m. tomorrow, we only come to do diluted EPS. Now, I'm so sure my students are very good at cash flow. That one is correct. Out of 15, I'm so sure most of my students here will be getting 10 plus, if they give us a cash flow question. I'm also so sure that my students, given a group consolidation question, those guys will be able to, squeeze so many marks there. All right. I'm also so sure that my students this time round, in terms of the theories, I've given you 3 videos, remember. In terms of any theory coming, I'm 100% sure that my students out of 30 or 27 marks, my students can easily squeeze 20 for theory. This time around, examiner down a motto. The only thing that I'm not seeing you guys doing very well, there are these small standards. Like, for example, we have these IFRS 2 share-based. If I were you, I'm even surprised. There are students who do not know how to study. for exams. I think we should have like a whole lesson to tell students how to study for exams, teach them. Because this is the time I'm seeing so many guys still working on that, like new questions from the past papers, which they don't even have answers. I mean, they're discussing, they're sending me the answer for this. Ladies and gentlemen, that time is gone. Right now, we talk of revising your revision. Revising your revision. Revising what you did in a class. The questions you did in a class. Even the ones that you understood best. Those are the ones now you should be revising. You go like through each topic, seeing this question in class, have the solution here. Can I reproduce these things like that? And of course, even when you are studying and then you come, in this case here, to an end, like, I can't understand this topic. I can't understand. You have reached that stage in revision, which we call JMO, which is just move on. Just move on. How come you keep away? Just move on. Just move on. And we shall overcome. We shall overcome. LMS iko hizo vitu ya. LMS iko hizo vitu. Saizi zile time ya kwanza kuangalia. If I were you, I would rush and watch IFRS 2. The videos that we did. Usiende hata kwa vitu vingine mingi. Right? Go straight away and watch something to do with the deferred tax. The videos that we did, you can do deferred tax 2 questions. All right? Get in this case, those 3 videos that we did, which covers the whole over the theories. Put your headsets here. All right? If you have, in this case, here, a small vehicle there, you're moving in the estates. I mean, let that be the thing that is what here, ringing in your ears. This is not the time to start studying new things. Trust you me. If you're doing it that way, that automatically will give you a very bad passport for me to teach you again next semester. And for sure, and God help us here. God help us here. I would want to teach you next semester, but in a serious paper like BDA, not AFR. These AFR, these things are not serious. They're not even very good. I would want to teach you guys next semester, but at a higher level, and to assist you. It doesn't matter whether you started reading yesterday. You just go to your LMS. LMS, choose the questions that you guys are what here, you guys are comfortable with. Those are the questions you're watching. And then I'd given you like a guideline. Long time ago, there's a video I did. How do I pass AFR 1 touch? Listen to that thing and you'll be done. You'll be done. So the only thing that I would want to struggle with you is EPS diluted. But all the other things, please don't, like now there's a student who called me yesterday. No, there are 2 things I would want to do for you. And I'd already done for you, but I want to repeat them. Like we have this step acquisition, group consolidation, where you had, for example, 20% of a subsidiary, and then you acquire like 50% in this year. So you move from 20% to 70%. So you have acquired this subsidiary in 2 steps. Where those steps, the original step has to be revalued. That I have to repeat here tomorrow. That don't have an obligation. I also have an obligation for you guys in terms of EPS diluted. But any other thing, when you call me and then you start telling me, Mwalimu, I'm trying now to do, you are not on the road going to CASNEP graduation. If this is the time you're trying to tackle very hard things, you're not on the road going to CASNEP graduation. People are going to CASNEP graduation, they are now revising their revision. What in this case they are very comfortable with. That's what you revise. All right? Not unless you really hear that, that I don't know how some students get to, although it's also very dangerous. This is very dangerous, especially when we are trying to fight even these fake academic papers. Not unless you hear that there's a leakage. Maybe that is when you can tell me, Mwalimu, come and do for us this and maybe, but I'll not even entertain that really, because that's academic malpractice. All right? Otherwise, thank you very much. My class has begun. Allow this ninja to disappear. Allow this ninja to disappear. Thank you. All the best. Be blessed. We are overcoming. We are revising our revision. We are revising our revision. And all of us are in agreement that no new questions now. Now we are not doing any new questions. We don't need. I think you are a good ninja. I need to give you a present. No new questions in the paid group. Not unless you are sending a question that already a solution is available, which are done in class. Stop in this case here. Stop in this case here, giving people new content now. No. I'm giving you a secret that all of us will be able to do what you have to pass. All of us will be able to pass. So then, that's a very good joke. I wish at the time I would have really gone through that joke of walking with heels, to example. I would have wanted, but now we shall overcome. Thank you. All the best. And of course, the ninjas who are watching this particular thing on YouTube, you need to do that thing. You need to subscribe. Hit a thumbs up, right? And of course, comment. Even these ninjas who are with me here on Zoom, they never comment on my videos. These are not very good ninjas. I'll get a way of disciplining them when they come for that CASNEP graduation. When they come for that CASNEP graduation, amen, I will discipline them. Yes, kesho we have a class Vero at 2 p.m. to discuss those two things.